Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Global equities falter as US sticks to its aggressive stance on hiking import tariffs on Chinese goods this Friday. Dow posts its sharpest decline since January. Lower production stops Vedanta from making the most of higher demand in the March quarter. Ruyas file yet another petition in the NCLAT challenging ArcelorMittal's bid to take over Essar Steel. ArcelorMittal rebuts allegations. And strong gold demand is expected to help Titan post healthy numbers in the fourth quarter. The numbers come out later today. Well, the world markets aren't a very happy place. You got to keep that at the back of your mind if you're trading Indian markets. Irrespective of what happened in India yesterday, the bigger news is now that the world markets are not turning out to be a happy place. US markets cracked yesterday. This was amongst the biggest declines that we've seen in the US in the S&P 500 since January 13th. The Dow 473 odd points. This wasn't the best day for the US markets, and it was a broad-based sell-off that we saw. In fact, a chart that we have shows you that how in the S&P 500 this was the broadest day of decline since the Christmas Eve sell-off. For people who don't remember, Christmas Eve was that one big day when the markets cracked and a large number of participants cracked along with it. It was not a concentrated sell-off. Yesterday was yet another day wherein more than 90% of the constituents of the S&P 500 saw a decline. So one, the index went down, and two, it took 90% of its constituents along with it. This is the first time that's happened in 3 or 4 months, or four and a half months, which speaks volumes about the kind of sell-off that we had in the S&P 500 in trade yesterday. All of that due to the trade tensions. And speaking of trade tensions, by the way, I think the Chinese markets would be eyeing the Chinese trade data, which is keenly watched out for amidst all of these US tensions, because one, what the reportage is, and then the market would want to extrapolate as to what the impact will be, because if the trade deal doesn't go through, then the impact on Chinese GDP, as also on world GDP, but the Chinese GDP would be massive. So I think the Chinese trade data becomes very, very important from what the Shanghai markets do in the session today. Speaking of world markets, by the way, while they are doing bad, our markets haven't been doing too well either. Yesterday, while the globe was not looking a very unhappy place, our markets cracked quite significantly, down lower about by 1% and slipping below the previous month low for the first time since October. In technical parlance, this is a very important thing, that the markets slip below the previous month lows, and that leads to some bit of technical indicators getting triggered. Let's wait and watch what happens today. By the way, keep in mind, we were talking about how there was a chance that the Nifty might brush the 11,550 mark trade yesterday, a level that it has steadfastly defended for a number of times. That got broken intraday yesterday and it stayed lower. So in any which ways, from that defense perspective, we were anyways lower. And now the fact that we've slipped below those October lows, the previous month lows as well, might only bring about some more jitters in the markets. The global tensions, of course, stay low, but what may also sour sentiment is the belief in dealing rooms yesterday that the political outcome may not be as favorable as the market was thinking about earlier. This was one big chatter that came out amongst key market participants that I spoke to yesterday post markets, and this is something that could keep markets on tenterhooks. It's of course keeping the FIIs at bay as well. The 4 days of the month of May and 4 trading days of the month of May, or 5 trading days of the month of May, we really haven't seen FIs put in a dime into the Indian markets. They have withdrawn money almost every single day. In fact, every single day, to the tune of 800 to 900 crores almost every single day. So that is also a bit of a worry when it comes to an Indian market watcher, because remember, unlike the previous past, DIs are not able to compensate the FI selling in equal gusto. The small, minute buy number, that doesn't quite live up to the kind of selling that we're seeing from the FI side. Keep in mind, the only positive, I think, from an Indian market perspective is that while all of this is happening to the globe, crude is coming off. It slipped quite considerably from the levels that it used to trade at, 74, 75. I think from there, it's lost about 7%. So that might be a small positive, but otherwise, it's looking slightly shaky. Everybody will be watching out for the Nifty earnings today, because it's a big, heavy day of earnings. On the Nifty, there's only one company, which is Titan. But important to see what Titan has to say about overall consumption, and therefore their numbers would be keenly watched out for. Not that too much of disruption is expected here, but the broader end of the spectrum as a clutch of interesting names. Rain Industries by itself is an important one table because it's a trader-friendly stock. Case International and what they say about the order book and the outlook ahead would be important. EID Parry from a perspective of what the sugar stocks might do, because those stocks have now been firmly in the headlines for a number of reasons. And then a clutch of financial names, Mass Financial, Satin Credit Care, Shriram Transport Finance, a lot of financial names coming out with numbers and something that the street would be watching out for. However, what will react at about 9:15 a.m. are 2 or 3 names that I thought were interesting. Now, the reason I thought Vedanta was interesting, and we'll throw more perspectives, I don't dwell too much on it, but look at the dichotomy in brokerages. The numbers were driven by strong performance in aluminum and zinc business, but volumes capped the profits. However, while CLSA remains bearish, and they have cut the target price to 135 from 170, and their principal reason is that there's slow ramp up in zinc and high costs in Hindustan Zinc, which are a concern. JP Morgan remains overweight. Their target price is 300, and they believe that India and the international zinc volume growth will pick up. So this is a wide dichotomy between how the street is viewing Vedanta. Nikki will speak more about this. I won't dwell too much on it, but keep in mind Vedanta would be a stock in focus. Z and this is an interesting one. The last few days have been slightly tricky, the last 2 or 3 sessions. But the SL Group released a statement yesterday saying that the stake sale talks are at an advanced stage. Now, the only problem with this is that, one, it doesn't give any kind of timelines as to when they would conclude. And 2, the fear in the market yesterday about the pricing of the stake sale being at a slightly lower price is something that's got the street a bit worried. Let's see how Z reacts in the session today. They have had some market share gains, but I think that is irrelevant right now. What matters is the price at which the stake sale is getting done and when it is getting done. And CEAT was an interesting one. I thought revenues marginally higher, but net profit dipped 16%. Margins have cracked. Let's wait and watch if CEAT reacts negatively in the session today. However, now time to tell you what's lined up on First Word. Portfolio managers chose to tread with caution in April. Sajid tells us why. Nikki, as I said then, joins in to come about Vedanta's numbers and how the individual verticals have performed. Somit takes us through the contributors behind Brigade Enterprises' 75% jump in profits in the March quarter. And then Darshan joins in later on to tell us what Dr. Reddy's done right to become the top gainer in the Nifty Pharma Index, I presume YTD. Let's start off with the interesting story that Sajid Mangat brings to us almost every quarter. Portfolio managers treaded with caution last month as they look to take cover before the election results come out later this month. Sajid Mangat, who's been scanning, as I said, through all the data, Johnson right now with the details. Sajid, sorry, not every quarter. You've now been doing it a lot more frequently. But what is the data suggesting? Good morning.
Good morning. To put it in perspective, you had the Sensex, which gave a return, positive return of 0.9% in April, and Nifty giving a 1% return in April. We saw the mid-cap index falling, giving a negative return of 3.6%. Which basically means that some buying that happened in the previous months, Feb, March, there has been some booking of gains which happened there. As we went into April, we saw the elections getting announced, and a lot of portfolio managers, a couple of them we spoke to, also said that they started hedging the portfolios because 2018 was a very bad year for them. Many of them lost assets under them. In 1 or 2 cases, 40-45% of the assets were wiped out because of the mid-cap and the financial services which happened. And they didn't want to get into an election season unhedged. The reason they've been telling us is that while it started off with politically started off with a strong momentum for the current government, as we went into the election, there has been signs and market participants are talking about it, and now some of the political parties are talking about it, that it could be a coalition government going ahead, and so it's a little risky to take a directional call on the portfolio.
At least a long only call.
At least a long only call on the portfolio, and that's the reason why they've gone heavily hedging themselves so that the portfolio is protected against any downside. There will be a movement to a directional thing on post May 19th or May 23rd, depending upon how the fund manager is going to do it. But the point is that they're not willing to take any risk, and they're trying to protect the portfolio at this point in time rather than doing. We saw a lot of money coming in the month of Feb and March into this. April, it was pretty much a flat with little amount of money, but it wasn't as big as that money coming there. So that was one of the takeaways which is there from there. Of the 50 portfolio managers which we track at Bloomberg Quint, 16 gave a positive return, and only 5 were able to.
This was for the month, or this is YTD? This is for the month.
This is for the month, April, for the month of April, and only 5 were able to beat the benchmark index, which is Sensex.
Okay. Keep in mind, viewers, that Sajid himself will tell you that the monthly performance is not the best way to scan, but this is important to show what the large community, which largely goes unnoticed because it's not very well tracked, is doing. I think that is the whole idea of doing this. And
this is a pool. So to give you an example, it's almost 120,000 crores of money which is being,
which is large,
right? So this is the amount of money which is in play here, and how this pool is working
in the market becomes very important. Yes, 100%. And a story around this would be there on the website too at some point of time in the day. If not already, so urge you to go out there on bloombergquint.com and try and read that piece of news as well, if you haven't quite completely followed this piece that Sajid was trying to bring. Sajid, thanks so much for putting this into perspective. Monthly performance from portfolio managers is very, very important to track. Moving on to earnings, lower copper, zinc and aluminum volumes hurt Vedanta's earnings in the fourth quarter. Profits, however, higher than estimates. And Kane India's investment in Anglo-American may have had something to do with this. Nikki Michandan is standing by with the details. Nikki, good morning. How did the numbers fare up? What are the key standout points? And what have brokerages made of this?
Sure. So, good set of numbers, better than what the street was, or the Bloomberg consensus was. EBITDA, we saw a surprise coming in, and I'll get on to the dynamics and the details of the earnings. The top line, we saw a 15% decline there to a number of 23,468 crore. We were working with a number of around 22,500 crore. So that's clearly a beat out there. EBITDA was down by 20% at a number of around 6,135 crore. But consensus was to the tune of around 6,050 odd crores. So there is a beat around there on the EBITDA level too, which makes the number look pretty. Margin at 26.1% as compared to 27.8%. The contraction was on expected lines. Profitability down by 46% at 2,615. This is mainly on account of the fact that there was an exceptional item in the corresponding quarter, the reversal of impairment charges that we saw in oil and gas division and iron ore division in the corresponding quarter, because of which we saw the PAT decline. However, on adjusted basis, if you look at the number is going to be an uptick of 8% to a number of around 2,615 odd crore. What essentially has driven the beat in the financial performance of the of Vedanta's earning around is the 3 divisions that I'd like to talk about, which is the Zinc India, International, Oil and Gas, and apart from that also the Aluminium division, which overall contribute to around 80 to 85% of the company's EBITDA. They have done extremely well. Zinc India, as we all know, that was an inline estimates number. If you look at that EBITDA segmental chart out there, Zinc India expected. International, we saw a huge surprise coming in from that division, mainly on account of the surge that we saw in the volumes and also the lower cost of production, which aided the numbers. Aluminium division also threw up a surprise. 397 crore compares to that of 1,234 crore. If you look at the table, that's a 68% decline. But then the consensus and the brokerages were estimating a further decline to that number. That has been prevented on account of the optimization of cost of production, where the company managed to show a good performance on the EBITDA. Power performance, where 39% downtake, pretty misses the estimate. Iron ore, again, it's going to be a good set of number out there. Copper division continues to make losses, but then that's reduced to a minuscule amount of portion of your overall EBITDA. What essentially has aided also the net profitability of the company is the other income, which is up by 77%. And this comes from nothing but the fact that the unrealized gain on MTM basis came in from the Kane India's investment in Anglo American, where there's a good surprise there. If you look at the quarterly numbers, that's a 832 crore realization that we saw. And even on yearly basis, we've seen 1,041 crore. It's only, Neeraj, if you remember in the previous quarter that the company came out with this announcement, and there were a lot of issues relating to corporate governance. But clearly that started paying off somewhere down the line. You know, it's a good return that the company has been making on this investment. Add to that, it's also outlined in the conference call as to when will it get the payment back completely. Also about the put call ratio, where they've suggested that the downside potential of the investment is also clearly laid out, which was something not seen in the previous quarter. The structured investment, as I was just mentioning to Neeraj out there, it includes a put option to ensure a minimum realization to the tune of around 4,189 crore, which means that the investment is pretty much protected that way. The company in the con call mentioned that it's already invested $270 million in Anglo as of FY19, and it will be further paying out $250 million in a span of next 4 to 5 quarters. But then the company is expected to get back as much as $520 million from Vulcan, that's the promoter company, by October 20. So that's clearly one line of clarification which has come out from the company. Though this remains to be a corporate governance issue, why did this investment was made in the first place, or whether or not it's the right way to deal about with it. But on financials, it's reflecting well. So I think the street will take a heart out of the development that it's not a risky investment and the company is actually making a fortune out of it. And also there is a cap to the realization that the company can achieve from this investment. So that's one good clarity that we got from the con call on Vedanta. Other things that I'd like to highlight about the earnings would be the gross debt, which has increased a little bit. That's mainly on account of the acquisition of Electro Steel and temporary borrowing at Zinc India.
Okay, Nikki, thanks so much for putting this into perspective. So definitely green shoots within the earnings and the highlights that came out post earnings. Keep in mind, Vedanta seems to be trying to clean the slate of sorts when it comes to the investments that they have done or the pledges that they have done, because earlier in the day, yesterday or day before yesterday, they also released this statement about how the promoters, which is the Vedanta Group, plans to clear up the pledge in Sterlite Technologies too. So there seems to be an attempt to try and salvage the situation. Thanks for the word, Nikki. Okay, so that's the verdict on Vedanta. Let's see how the stock reacts. Brokerages, as I said, have a divided opinion, as well they usually do. But maybe no divided opinion on Brigade, because the numbers by and large seemed okay. The profits jumped 3 times in the fourth quarter with the top line growth of 75%. The margins left a bit to be desired though. But let me get in Somit Sarkar, who's standing by with how the numbers shaped up and what's aided those numbers. Somit, good morning. Why Brigade today?
Well, good morning, Neeraj. So for Brigade, I'll start off with the consolidated, with the headline numbers first, and then I'll explain what aided the bottom line and on the EBITDA front. So if you see the headline numbers for Brigade, the revenues were higher by nearly 75%, while the EBITDA jumped nearly 60% compared to last year. Margins, however, contracted to 28.3%, while the net profit of the company jumped by nearly 3 times to close to 60 crore rupees. Now, segment-wise performance, if you see, it was the real estate segment which shined in the fourth quarter of financial year 2019, with revenues rising as much as 99% compared to last year. However, the EBIT margins slipped by nearly 450 basis points in the fourth quarter of financial year 2019. Now, the hospitality segment, now that saw a revenue jump of nearly 37%, while its EBIT margins expanded by as much as 1,000 basis points. The leasing segment saw a revenue jump of 12%, while the EBIT margins expanded by nearly 43 basis points for that segment. So what aided the top line and the EBITDA in the fourth quarter? Well, it was purely on the back of higher residential and commercial sales area. Now, in the fourth quarter, the company sold residential area was up by nearly 2.4 times to close to 8.63 lakh square feet, while the commercial sales area were up by nearly 30% to close to 0.95 lakh square feet. However, due to lower realizations, the company's margins did slip in the fourth quarter of financial year 2019. Now, the realization per square feet declined to nearly 5,426 rupees versus 5,509 rupees in the last year. So that's the reason why the margins of the company did slip. Now on the bottom line front, if you see, obviously the higher EBITDA did aid the bottom line, but along with that, higher other income, rise of higher share of profits from associate companies, and no exceptional losses did aid the bottom line more on in the fourth quarter of financial year 2019. Now, if you see the other income, that was up by nearly 26% to close to 18 crore rupees, while the share of profits from associates, now that jumped by nearly 3.5 times compared to last year. Also in the base quarter, there was an exceptional expense of close to 11.5 crore rupees, which also marked the last year numbers. So that's the reason the bottom line jump was nearly 3.3 times compared to last year. Now on the debt side, if you see the company's net debt, that was higher by nearly 22% to close to 3,000 crore rupees. However, its credit profile remained largely stable as its net debt to equity was close to 1.3 times versus 1 times last year. However, due to higher debt and due to higher borrowing costs, the company's finance cost did inch up a bit higher compared to last year, and that also weighed on the bottom line in the fourth quarter of financial year 2019. Lastly, in the key other important updates that the company said was firstly that that close to 128 lakh square feet of that they have close to 128 lakh square feet of ongoing projects. Along with that, they also plan to launch projects which cover a total area of close to 64.8 lakh square feet. Along with that, the company also said that they have a land bank of close to 431 acres, which for which it has incurred a cost of close to 1,400 crore rupees so far in the financial year.
Okay, Somin, thanks so much for putting that into perspective. The numbers optically look very good if you look at the top line and the bottom line. Margins may be a bit to be desired, but let's see what Brigade Enterprises does in the session today. The last piece on First Word today is about Dr. Reddy's. That company is showing a healthy recovery, or the stock is showing a healthy recovery, let me put it that way. US regulatory issues had eroded more than half of the market value from the peak in 2016, but the drug maker seems to have cured most of those ailments to jump 42% in the last 12 months and become the best performing stock on the Nifty Pharma Index over a one-year basis. So what's exactly changed? Darshan Mehta standing by with an analysis. Morning, Darshan.
Good morning. So basically the Nifty Pharma Index, at least in the last 12 months, is up just 5%, while Dr. Reddy's is up almost 42%. It had concerns initially. If you see what exactly has happened, it's outperformed that DV's Lab and a couple of other pharmas, while the other pharma companies have seen a big drop that's come in. Now, basically, if you see what's happened as far as the stock price is concerned, it's gained significantly. If you look at what happened a few years ago, they had issues as far as their regulatory issues are concerned when they received the warning letter in 2015, and post that the stock did manage to correct significantly. Now they've done a lot of things. So we've highlighted 4 or 5 points why the rally has happened and what's changed for Dr. Reddy and how it's becoming much more fitter and leaner. First of all, the US FDA issues pretty much seem to be solved. Now only one plant is under the warning letter. The other 2 got cleared. One got Miralguda got cleared a while back. The Duwara plant got cleared this year itself. So only Srikakulam API plant is left, and Bachupalli, in which the street anticipated there will be negative adverse reaction. That did not happen. That plant also got cleared. So they're out of the US FDA woes, only one plant, and probably that could get cleared. The focus now shifts to other markets apart from the US, because that is becoming competitive. India, China, emerging markets. They appointed a new India head. They appointed a head of new chronic business in India. So from a 2% market share in India, they're looking to grow significantly in India. So that's the focus that they are. And the other they're making operating profits in the other markets also. The Russia market is doing well. So that is doing well. The focus now is on China. If you see when Dilip Sanghvi spoke about it, the interview in Bloomberg, he spoke about China. Yesterday, Alembic Pharma came out with a saying that they are going to China. So China is a big market now. They announced plan to open market to international players. Dr. Reddy recently got an approval for a big drug, $1.6 billion drug, and they've been part of China for the past 20 years, but efforts seem to be paying now for Dr. Reddy's there. The US dynamic seems to be changing for Dr. Reddy's now. They now want to focus on complex generic drugs using their own APIs, which means that the margins probably will go in higher, and they're looking to cut losses by divesting the non-core assets and the businesses which are not doing well. They also indicated that they want to exit the unprofitable business. They recently divested 3 derma products. They sold the active pharma the API unit in Hyderabad. So that is something that they did. And the last and big positive came in when they won the Suboxone case against Indivior. So that is something that aided them and that helped them. So a couple of reasons why Dr. Reddy seems to be outperforming the other pharma markets. It's trading at a fresh 52-week high, while most of the other pharma companies haven't done well for it.
Oh, interesting to see this one do so well. Thanks, Darshan. Thanks so much for putting that into perspective. That's Darshan Mehta with an analysis on why Dr. Reddy's is doing what it is doing. That's all that we have on First Word today, though. Lots more lined up on Indian Open. We discuss what the charts are showing with Gautam Shah of JM Financial. So that will be an important conversation. Decode the March quarter earnings with Ashish Kumar Chauhan of BSE and Rajiv Gandhi of Hester Biosciences, and how affordable are houses in some of the key real estate markets in India. We talked to Gulam Zia of Knight Brand.